Hello and welcome everybody to the Annuity Straight Talk podcast, episode number 113. My name is Bryan Anderson. I'm your host, founder, and creator of AnnuityStraightTalk.com. If you want to schedule a call with me to talk about your retirement concerns, get the best answer you're going to find, top right corner of any page on AnnuityStraightTalk.com. Subscribe or comment on any of your favorite podcast platforms or on YouTube. Share it with your friends, your advisors, anybody who has a bone to pick. It'll only make it better for everybody involved. And one of my favorite guests is here this week. We got John from California. Say hello to everybody, big guy.
Bryan, how are you? Good morning. Welcome, everyone. I'm glad to be back, talk about some volatility in the market as we head into 2026. It's going to be an exciting and perhaps a stressful year. We'll see. How are you?
So I'm good. Everything's fine. Stayed busy and mellow. I like that. And it's interesting. We come with these, you haven't been on for a while, and there's always a good time to come back and say, hey, what do we look at? What are we seeing? I think, and I'm getting more and more comments from people that just an uneasy feeling about the world in general. There's a lot of geopolitical stuff, major moves. You got Venezuela, you got China, you got Greenland, you got all this garbage. They're hauling people off the streets in Minnesota. Everybody's upset. We're getting yanked all over the place with the news cycle. What does this mean for the portfolio, man?
Man, I'll tell you, it's been an exciting year. We had a unexpected repeat of 2024 in 2025. The markets were very strong, pretty resilient. We had very little volatility after the April tariff tantrum when we did have a 25+% drawdown in 2 weeks, and then a snapback after the tariffs kind of tacoed.
Yeah.
Were paused, and we had a really tremendous run in a lot of stocks, not only just chip stocks, now the memory stocks, companies like Micron, SanDisk, which just recently became public again after an absence back in the private markets. You're seeing Western Digital, Seagate, all of these stocks ran from below $100 to the mid $300, $400, and $500 ranges. Unbelievable moves. Was not expected, but the memory and the AI trade continues. But there has been a ton of weakness in technology. It's a bifurcated market. You have the hardware side, which is actually doing fairly decent until just the last week or so, and then you have software, which has absolutely gotten crushed under the narrative that software companies are going to either trade at a lower multiple because of AI, or they're just going to go away entirely. Now, that has yet to be seen, but I think certainly has been some pressure in that sector. So if you own software companies, and I admittedly own a lot of software companies, you're down 30, 40, 50, sometimes in circumstances 60, 70% in the last 6 months. So it's been a rough go. Meanwhile, your banks and your tanks continue to move higher. Your energy complex continues to move higher, as well as your dividend stocks as a flight to safety over let's call it the last month.
Yeah. So it's what happens all the time, where the overall index is fine, and for anybody with a diversified portfolio is doing well, but the individual stock pickers, individual sectors, depending on that. And this is what got people in a lot of trouble over the last several years, and a lot of people that weren't necessarily catching the rebound in the market from different points in time, is that they were in a more specific stock portfolio in an industry that got hammered, whereas the overall, and that's the AI, the Nvidias and stuff like that, or the big seven from the past year, the tech companies that were carrying everything, but any of the other stocks didn't do that well. So not everybody's making a bunch of money right now.
Yeah, absolutely. Last year, small caps underperformed, mid caps underperformed, healthcare underperformed. And we saw UNH, which is United Healthcare, the largest health insurer in America, go from roughly 600 down to 240. Now, it did have a decent rebound, but there was just some news announced last week where the stock dropped from 340 back to 280. So a ton of single stock volatility. I can say if anyone owns single stocks, they trade very differently from let's say your S&P 500 indexes. Mm-hmm. And what I've found is that if you start to get a rollover in some of those larger cap, mega cap stocks, the ones that represent the top 10 stocks in the S&P 500 market cap weighted index, represent about 35 to 40% of the index. So it's a front weighted index. You're going to start to see if those companies, the Apples, the Microsofts, the Googles, the Amazons, if those start to falter, you could see some real big damage. And I'll show you later on a chart the bifurcation of different stocks in the market from Amazon and Google, Meta, Facebook, all of these stocks. Some of them have reported record earnings, but they've fallen anywhere between 10 and 20% in the last, call it 3 to 4 months. It's been an unbelievable ride. AMD ran from 97 in April of last year to almost 260. Yesterday, I believe it was sub $200. That's been a rough ride. A lot of these names are getting hammered, and I can show you individual to show you where the carnage is. But other areas where people didn't think they were working last year, and they ended up getting rid of them, or they didn't believe in diversification. Those are the areas of the market that actually work. So when you talk about indexes or sectors of the economy or individual stocks, you got to think about all of these things in a portfolio, and your portfolio is all of your kids. They all mature at different time points. I actually have two boys. One is still a baby and one is growing into an adult teenager. And so I love them both equally. We struggle at times and butt heads. And so you've got to continue to embrace them even when they're struggling, because at some point in time, they do turn around and they really start to shine for you. And you got to think about your investments that way. You can't just throw the baby out with the bathwater all the time.
And that's where what's interesting, that I was just going to say, that's why these are really important every now and then, because it teaches people. I think a lot of people are in that, leave it alone, it'll be fine. And to some extent, that's okay in the long run, but really pay attention to the pieces and parts of it so you understand like what creates a full market and how that can affect your yield. Obviously, if you're picking against the major movers, even if the index is stable, you can make a lot of money. That's my pro friend on Wall Street loves it when there's volatility. He loves it when there's stocks that lose 50, 60%, because that's where he makes his money in trades and options and do that, all that kind of thing. But it's a different game than the average retirement saver is dealing with. They're not professional traders, even if they think they're doing pretty well, right?
Yeah, absolutely. And I can tell you from personal experience, I've been doing this for over 25 years. I trade a tremendous amount, and it's tough. You get emotional about trades. You end up losing some money, and you make bad mistakes. And sometimes and as you and I have talked about this journey, I've made some pretty big mistakes. And the biggest thing in retirement is you have to avoid mistakes. If you make mistakes that you cannot correct, you don't have the time, you get yourself in some trouble. And you feel bad about yourself too. You want to kick yourself. You have to go into this money game, the financial plan. You actually have to have a game plan. And I think that's what you do really well with your clients, is help coach them through how to put together an income plan, how to be properly allocated towards different types of asset classes, whether that be annuities, whether that be dividend paying stocks or growth stocks. You don't give that stock advice, but you help really quarterback the plan. And then I help fill the gap with the securities or the risk side of the equation. So you, as a prudent investor, you have to have both bases covered. And I know there's a lot of guys out there that only believe in one thing or another, but I think that there's a lot to be said about having a really good game plan going into retirement.
And that's where I don't always want to use this as a pitch for annuities, but I can tell you of the people that I know which ones are less concerned about the fluctuations in the market and the price of stocks. I know some people that aren't affected by it at all, don't care. And other people are set up for it and can handle it and will be fine regardless. And there's some people that think, oh, everything's fine and everything's great, I'm chasing all the return I can get. And those are the ones that are going to sit in position to get smacked at some point. And that's okay if that's what you want to do.
Yeah, absolutely.
Don't say I didn't warn you.
It's investor psychology. Times like this, when things get volatile, and the indexes are really not off of their highs too much. We're having a great bounce back today, down yesterday. tremendously back up today, but I could take you through some charts and give you real world examples of, hey, if you don't take a profit at some point or you don't rebalance your portfolio. I have our firm, we just crossed about 520 million in assets under management. We manage a large amount of money for people. And it's usually when times are the best that people ignore advice. They want to continue to ride the train. And it's just prudent portfolio management to rebalance on a periodic basis.
No matter
You
what, right?
no matter what, you can't believe how many people that I've contacted via email, via phone, who have either not gotten back to me or have ignored my request for a meeting. And these are clients. We manage their money on a daily basis because they don't want to sell a lot of their winners. And I can show you what happens when you don't sell a winner,
Yep.
or you don't at least trim it and take a little bit of a profit and bring it back into its original allocation percentage. It can really cause some damage.
Okay. Why don't you, show us what you want to show us. Give us maybe a best case, worst case range for, say, the next few months. Tell your, hey, man, next time you're on the podcast, you might be here in Montana this summer.
Yeah, I'd love to be. We had a great time. What did we come back? We went up there in June, spent some time on the lake.
Yeah, it was right after I got back from Alaska. Yeah.
Yeah, my boys really loved it. So it's a really special place. But I can take you into some, I can take you into some charts.
Okay, let's do it. And while you're setting that up, just remember John's doing this as a service. It's because we're buddies, just a useful information. It's not marketing on his part. Do not look him up. Do not call him. Do not bother him. He's a busy guy. He's a family man. If you do want to talk to him, talk to me first. I'll see if I think you guys would be a fit. But anyway, leave him alone and just say thank you for coming here and giving us some real analysis. Okay, go. Take it, big guy.
All right, so I'm going to show you right now. This is the stock heat map, actually. And what you're seeing here is, what are the stocks doing today? You can see Nvidia is up almost 7%. Amazon's down 6%. So both of these are large components, probably two of the largest companies in the world, along with Meta, along with Apple, and along with Google and Avago. These companies, really, Apple is the lone wolf that's held in there. Nvidia has fallen from 212 to the low 170s. It looks like it's up pretty considerably today, but Google and Amazon reported earnings this week. They had tremendous earnings, record bookings, record guidance, yet both of the stocks have traded off 10 to 15% in the last couple of days. Amazon reported last night they're going to spend $200 billion in capital expenditures this year. When you look at different individual stocks, you have to realize how big these companies are. Google is going to spend upwards of $100 billion. And Meta, which is Facebook and Instagram and WhatsApp, Mark Zuckerberg, they're going to spend about $100 billion on this whole AI trade. So you can see the dispersion in the market. Now, we do have an update. All the indexes are up except for these underliers, but they did report earnings. So I'm going to take you through a couple individual stocks and some indexes to give you a kind of a snapshot of the bifurcation in the market. I can show you Nvidia. You can see Nvidia has been consolidating for quite some time. We could say it's been consolidating since July of 2025. So for 6 months, the stock has really not done a whole lot. It's right by its 200-day moving average. It did pop up today, 7%. It's trying to recover. Here we are. We have a bout of resistance up here. So Nvidia, it's the hot AI stock. It's the chip stock. They do report earnings I believe it's next week, February 25th. So a couple weeks out, that'll be a big sign if we get a break in the market. So you can see we went down, we touched the 200-day moving average. You can see how far it was from here. The 200-day came up to it. But I would really watch this stock. If it breaks the 200-day moving average, look out below. You're going to go back down to about the 150 range. I can show you stocks like Meta. That's Facebook. You can see they reported earnings back here in October. They just reported earnings again. They had a huge gap up. And what did they do? They gave all of their earnings pop back. That's not a great thing. You get a really strong market, you get a really huge pop. You would want this to continue. It failed to break all-time highs here. So you have right here, you have the peak back in, let's call it, this was in October. I'm sorry, it was in August. And then you have a lower high, you have a lower high, you have a lower high, you also have a lower high. I don't know. Is Meta now in a downtrend? What I call a stage 4 decline. On the other hand, we could take a look at Google. Google has continued to make gains in this market, continued to capture market share. Google was a stock that everyone said AI is going to kill search, AI is going to kill Google's business. And you can see where they were back in early May, June, July in the summer. They were $158. They did have a court ruling that came out, and they said that they could work with Apple on being their default search engine for Apple's Safari browser, which is all in all the iPhones and all the iPads and whatnot. And the stock just took off and it re-rated, and they came out with a certain chip that's cheaper and runs faster than the Nvidia product. And they're running those chips. They're called TPUs, not GPUs. And the stock is just re-rated and continued to run higher. Then you have Apple. Apple struggled a little bit. They had good earnings, but you can see the stock has been pretty volatile. It hit a peak back in December and it traded down. I mean, we're talking Apple, and I had this conversation with a client. See, Apple can never go down. They probably don't remember Cisco, which back in the .com was the largest company in the world. What's to say? What happens if someone comes out with something better than the iPhone? People start to switch. Apple was down 16% until their earnings. They've popped back up. They're going to try and test this. We'll see what happens with Apple. What are the other big names? You've got AMD. AMD really struggled. It had a double top, hit 265 back in October, struggled a bit and hit 267, and then it announced earnings and it fell almost all the way back down to its 200-day moving average. That's not a good sign here. It's trying to recover today, but you can see a lot of damage has been done. I wouldn't want to be holding this stock at 265 and have a $74 retreat. There's some other stocks that we can talk about. You can talk about Palantir, which was the darling of last year. Palantir hit a high of 207. It's well below its 200-day moving average and falling like a knife. Normally, the 200-day moving average is a very key level that needs to hold. And we're seeing a lot of stocks. Remember, this is a $400 billion company that only does $4 billion in revenue. Its forward multiple at some point was like 700. It was something crazy. I like the company, but do I buy it at this level? Look where it came from. At one point, a couple years ago, it was an $8 stock. Even down at this level here, you're getting a little bounce here at 125. Who's to say that we don't fall down to this $52 level in a bear market? We're not in a bear market yet, but you can see this was a stock that could do no wrong. And you're literally off the most recent high. You're down almost 35%. So those are some individual names. Right. I can show you, I mean, we can look at Amazon. I just want to touch on some of these big names. Amazon, big fall back in early March, recovered all of that, and look where it is today. It just knifed through the 200-day moving average. It's trying to recover. I'd like to see something like this, trade sideways, and then maybe come back up like that. Who knows? I think Amazon has some good prospects, but spending $200 billion in a year is a really big task. $200 billion is more than some countries make in a year. You have to keep that into perspective.
Yeah, it's big money. Right? Hey, you don't have to tell me. Got to control costs. Doesn't matter what revenues are if you can't control costs.
Yeah, so let me show you just a couple more to keep things in perspective.
Okay.
Energy. No one loved energy because oil was down last year, down to the mid-50s. Look what energy's done this year. So we're having a rotation from growth to value. Energy companies have high cash flow. Even the price of oil is low. These companies continue to generate significant amount of free cash flow. Rode along its 200-day moving average here, and boom, beginning of the year, they decided we're going to take energy higher. Same thing with value stocks. SCHD, which is a stock that many of my clients own, it struggled last year. I'll be honest. It was in a downtrend. It was sideways and in a downtrend. It started its recovery and then it had a little bit of a hiccup. Look what it's done this year. The stock is up since the beginning of the year. Stock is up as a sector almost 15.5% versus growth. I'll show you the growth complex. So you have a rotation from growth to value. This is a value play. SPY-G is another stock that, or another ETF sector that a lot of clients own. What has growth been doing? Since the beginning of the year, and I'll just go back here to the beginning, growth is down as a sector almost 6.5%. It has recovered. It's down about 4, but still, you're up 15 on value. You're down 4% on growth. So you have to keep that in perspective, and I can go into some certain sectors if you like.
Yeah. We don't want to go too long, but overall, it's important to, again, look at the individual components, and those are the bigger players in different sectors, right?
Yeah. Let me just show you the IGV last. Here's the IGV. This is the software complex, software as a service. You can see it is at its tariff lows. So last year, these stocks were up 55% overall.
And they're back down.
This is what happens when you don't pay attention. You have to take profits. You have to rebalance. You have to be prudent. You have to, because this complex is fallen 32% since November. It just keeps getting worse and worse. Salesforce, which is one of the largest ones, it's down 27%. ServiceNow, these stocks are just getting decimated. HubSpot, just getting decimated. DocuSign, which is one of my favorite companies, has gotten decimated, down 35% since the beginning of the year. So you have to keep things into perspective. You just have to be resilient in what you're doing. So I'm going to leave it at there. I know that's a lot of information. Hopefully we can get a recovery and we'll go from there.
Just a good quick look at it. Overall prognosis, top, bottom, next few months. What do you think? A lot of headwinds.
I don't think that the market crash is coming. And I'll say that for a couple reasons. I'll say you have a new Fed chairman that is going to be coming into the office in May. He's been on record as a hawk in terms of interest rates. I think the president picked him. Love him or hate him, I think the president picked him because the guy's going to lower rates. We need to get housing going. We need lower rates. We need corporate refinancing. We need to refinance our national debt, which is at $37 trillion. No thanks to a lot of the fraud that's being uncovered in this country, which is a whole nother topic.
And I don't think we've even seen the beginning of it.
No, I don't think we've scratched the surface. But on that hand, and I don't want to go down that rabbit hole, we have the midterms coming up in November. And you have the GOP, the Republican side of the House. They don't want to lose the House. They don't want to lose the Senate. The president is probably pretty fearful that if he loses the House and Senate, he's going to get impeached again. That's just the vitriol that we have in this country. It's unfortunate that we can't get things done. But whether he deserves it or not, it's not my place to say. But I think what's going to happen is that as the midterms come in, the new Fed chairman comes in, we're going to have a QE, quantitative easing, and a lowering of interest rates like we've never seen before. It's going to rip the market to all-time highs, potentially 7,500, and then we'll see what happens. Could get a huge multi-decade. We could get a pullback that we haven't seen since maybe COVID or since maybe the 08. I don't know. I'm not here to predict markets. I'm here to help people navigate that storm.
Yeah. All right, cool. I appreciate what's happening, everybody. This is not ever meant to make anybody freak out, give you comfort. The idea is solid planning on all fronts, especially in retirement. Have set aside what you need so that these short-term effects or short-term movements in the market do not decrease your standard of living, do not put you in a financial bind. We want to keep you away from that. John, thank you so much for being here. Appreciate you giving me a week off so I didn't have to write anything, but I got to go back next week. Anyhow.
Brian, I look forward to seeing you soon.
Yeah, you got it. We'll do it. Guys, this has been episode 213, talking about market updates for 2026. If you guys need to get a hold of me, top right corner of any page on annuitystraighttalk.com. Thank you for joining me. I'll be back next week for episode 214. Have a great day, guys. Bye.